Hey everyone, it's Austin over at Oxford Retirement. Just wanted to shoot a quick video on something that has been the topic of conversation definitely in the last 6 months. The ACA subsidies, the Affordable Care Act subsidies. They have been around for a good long time. During COVID, Biden had passed some increased subsidies, so basically the government was helping pay for a lot of people's health insurance up until this year. This year, nobody did anything, and they were scheduled to lapse. They did lapse, and so a lot of people that I plan with are starting to pay these much higher premiums because they're no longer eligible for the subsidies. So I wanted to shoot a quick video on the way it works and how it used to work as well, because now this has come back into play and people need to be aware of this. There's a threshold on your income to where you stop getting the subsidies, and it's just a cliff. So a lot of things in our tax code are more progressive. So what they'll do is they'll tax you at a higher rate the more income that you have. But if you make an extra dollar, you don't go backwards. You just stop going up as quickly. Excuse me. And so instead of keeping 90 cents on the dollar, now you're going to keep 88 cents on the dollar or 78 cents on the dollar, so on and so forth. But when we're talking about this specific subsidy, making that extra dollar and having that as income actually can remove the whole subsidy, and you can be hit with this almost $18,000. I'll show you for the year for a couple. You'll be paying that much more throughout the year for health insurance. So it's a really big planning point, and I've been asked a couple of questions. So just really quickly, the way the subsidies are based off of is 400% of the federal poverty level. And so depending on your household size, you can see this website here, it's 𝗖𝗋𝗋𝗋. If you're single, the 400% level is at $62,600. For a couple, you're at $84,600. So staying below that means you get a subsidy. If you go over that, you lose the whole thing. And it's just $1 over, you lose the whole thing. So if you want to see how this works in practice, if you go to healthcare.gov, and I show people this all the time, if you go under Get Answers and you go to where can I find marketplace plans and prices, preview plans and prices, you don't have to enter in all of your information to take a look at what this really looks like from their website. What you'll do is you type in your zip code. Okay, that's Sun City here. We'll go and say, who's in my household? Well, it's me and my spouse. Okay. Yes, I'm married. No other dependents. And I'm 62. I don't know if you can tell, but I'm not quite there yet. None of these apply to me. My spouse is 62. None of those apply to her. And so that's my household. And then they ask, how much income are you going to make this year? You have to estimate it. And so let's put in $84,600. There's my subsidy. The government's going to pay $14.74 a month towards my health care if that's the scenario. Now, it's an estimation. You tell them about how much you think you'll make, and then at the end of the year, they'll reconcile that. If you went over that, okay, they may ask for some of that back. Let me go back one section and just say $1 extra. Well, now you're not eligible for the premium tax credit. So again, $1,474 times 12, that's $17,688 you lose by making that extra dollar, okay? And so the way they calculate your income is very important. It's your AGI, going back to 𝗖𝗋𝗋𝗋 here, plus the untaxed portion of Social Security. So they're really looking at the whole thing. They don't care how much is taxed or not taxed. They're looking at how much Social Security did you get, all of your other income from AGI, tax-free interest if you have it, and then foreign income if for some reason you had that, right? And so it's really important to stay under that if you want to try to plan to get the healthcare subsidy. So you can see the full price plans after that. Here's a catastrophic plan, $1,600 a month for the couple, $800 a month. Your deductible is $21,000. Okay. If I had that subsidy, we'll go back here again. Now we're looking at a bronze plan, not catastrophic. Deductible's a little lower, but my premium obviously way, way, way better. So just an important thing to plan around. And then I'm going to give you a couple of ideas on how to plan around that. Number one, it depends on where your income's coming from. If the income you're using is in an after-tax account, such as a brokerage account or a Roth IRA, that sort of a thing, if you're taking money out of there to live on, that's not necessarily taxable. There may be some interest, dividends, capital gains, or something of the like there, depending on what account you have. But like money in the bank, that's already paid tax. You're not, if you use that for income, that's not counting as additional income. You've already recorded that. And so using some of that money can be a way to plan around to make sure you're under the threshold. The other way, maybe not as advantageous, but taking out a loan, a personal loan, a HELOC, second mortgage, something like that, and using those funds and living off of that for the brief time period. Because these plans are really for people that are not 65. They're not eligible for Medicare yet. So you've got to have your healthcare.gov plan. Once you're up and above, the Medicare age, things get a lot easier and there's no thresholds and things to worry about like that. But if you're retiring early, this really starts to play a role. So if you were to take a loan, yes, you'll pay interest, which is the downside, and you'll need to pay that back with most loans. But maybe that gives you the income you need so that you don't have to take money out of your IRAs, 401ks, taxable accounts, so that your income looks lower. Okay. Now, it's not right for everybody. I'm not saying there's a perfect strategy here, but it's something to be aware of and consider. Thank you for joining me. Talk to you next time.